Ladies and gentlemen, it feels so good that COVID restrictions are becoming looser. I don't even mind that we have the coldest and wettest spring in Switzerland in over 30 years. And I'm actually not the only one who is upbeat. We see this in all economic surveys. Households and companies are becoming more optimistic, and then they intend to spend and invest more heavily. Order books are so full that the main problem companies face now are increasing delivery times from suppliers and tighter supply of spare parts, making them more costly to purchase. For us, that was enough reason to increase our growth and inflation forecasts for this year and next, both for Switzerland and the euro area. Some fear that inflation is not only increasing temporarily, but becoming a more severe, longer-term problem. I'm more relaxed, as I still do not see wages picking up in Europe significantly, and that is what would be needed for a sustained increase in inflation rates. In the US, labor market dynamics provide a different picture. As a result, we increased our US inflation forecast to 3.4% for this year, far above the 2% target of the Fed. US unemployment is falling, and increased job openings are reflecting the fact that labor is becoming scarcer. US inflation is expected to peak in June, and we forecast it to be more sticky than what the US Central Bank assumes so far. As a result, we expect that the Fed is starting to prepare a tapering of its asset purchases. This would help keep inflation expectations in check, but would somewhat increase real bond yields. We are therefore careful with investments like gold, which most importantly depend on low real yields. Still, we do not expect a material regime shift in bond markets, as the forces that led to low real yields continue to prevail. In particular, the huge savings surplus of private households and companies in developed countries. As such, we expect the yield on 10-year US Treasury bonds to remain below 2% till the year end. This is also important for equity markets, where valuations are high, but not irrational. On the contrary, they can be well explained by the combination of increasing earnings and low yields for other assets. However, for the coming quarters, we favor different markets than in the past. In particular, we would no longer have an overweight on the US, as its recovery started earlier and has largely been priced into markets. What we like is the European market, and we are also turning to emerging markets again, which have lacked global equity market developments in the first half of this year. Equity sectors that we like best are healthcare and utilities, for their relatively low valuations. And in case you are worried that inflation and interest rates are picking up, insurance and banks should be a good choice, while real estate should be avoided. Finally, as I'm always getting questions on crypto assets, let me add that as a sustainable asset manager, we definitely don't like their energy intensity and their zero yields. Let me conclude with 3 points. First, we are confident that GDP growth will be strong this year and next, driven by a catch-up effect, but also resulting from the technological changes that have been turbocharged by the pandemic. Second, inflation needs to be watched in the US, where fiscal and monetary stimuli were strongest, and tight labor markets might lead to increasing employment costs. Third, we expect bond yields to increase only slightly, as central banks are in no rush to tighten financing conditions. In this environment, equity markets are fairly valued. For the second half of the year, we prefer Europe and emerging markets to the US and sectors like healthcare and utilities. Ladies and gentlemen, thank you for your interest and have a sunny summer ahead.